Good afternoon, everyone. Anthony Iser here with another ITPM Flash. Well, it's Wednesday afternoon. We've had a pretty decent day in the market. We've had mixed results and mixed performance, though, over the last week, and certainly had mixed economic data. But for the time being, the market's saying things are okay, and they're probably saying rate cuts are coming. That's what's getting factored in for September at the moment. And that's what the market needs to see. Now, everything is a little mixed. I'm going to talk through a few positives I see, a few negatives I see. And while we're not in the market of predicting outcomes, we want to be reasonably agnostic. We'll have a portfolio bias. I want to talk about how I'm going to hedge that outlier downside risk that might happen if we see continued weakness in some of these economic numbers that seem like they've rolled over. So firstly, the positives. Hyperscalers are spending like crazy. As you can see from this chart here, we've got huge amount of spending increases over the last couple of years, and this is going to continue. Looking out to 25, 26, 27, 28, all the way through to 2030, there seems to be no let-up in the size of the CapEx spend. And this, as we know, rolls through the whole AI infrastructure, from GPUs and tech hardware to cooling, to building, to cement, to roads, to restarting nuclear power plants. All of this is super positive. It creates jobs, it creates wage growth, it creates economic demand, and consumer spending will pick up on this. So this is a massive tailwind that the US market has over the medium and longer term. Secondly, we're into results, and the results have broadly been pretty good. There's a few misses, a few hits, but on the whole, we've seen beats, as this chart shows. 63% of companies have beaten expectations, 10% have missed. Now, expectations have been pretty low, so that's some degree not surprising. But the outlook for a lot of companies has been reasonably benign and maybe even strong, certainly very strong in the tech world. That's another positive sign, because if we roll into the second half, historically, as this chart shows here, the green line, we normally see earnings upgrades coming through. And that is 10-year average. We're likely to see it for these next couple of years as well, all else remaining equal. And as I said, it's Wednesday, post-market, we've seen retail trade numbers come through that were really strong. And this to me is a little bit unexpected, but that's not unusual. We've seen 6% year-on-year growth. We've seen the retail names up strongly, and we've seen a couple of those AI hardware names perform really well. A-Lab was up more than 20% on results that not only met expectations, they beat them, they upgraded, and that's the sort of thing that can drive a market onwards. So at the moment, with inflation data due out next week, it feels like we're sort of poised at a potential little pivot point for economy, rate outlook, and market outlook. So CPI, if it's a benign number, then rate cuts are probably locked in for September. Market can look forward to that. Bit of strength, a little bit of liquidity easing across the consumer. Things, soft landing would be back on the agenda. However, if it comes in a little hotter, and it gives pause for Powell to say, sorry, we're not going to have a rate cut until this inflation is done with, then his nickname is going to hold true. It's going to be too late, Powell. Stagflation will come back onto the agenda, and the market probably could be under a bit of pressure. My concern is what happens with that scenario. If that plays out, how do I protect myself? So firstly, I want to run through some of the negatives. Now, the employment data that came out last week was revised down, and Trump fired the person who was responsible for it, and it was all, false numbers and blah, blah. The reality is that all employment data at the moment is pointing to the same thing. So ISM manufacturing, the weakest in 10 years if we exclude the pandemic. ISM, third weakest in 10 years if we exclude the pandemic. Indeed, job growth opening index down 40% from its peak back to pre-pandemic levels. So everywhere we look, there is weakness in this job market. That is not a good sign. Okay. Now, it's across the board and it's starting to show up cost-wise as well for companies. So you can see here, top line still growing well. Expectations and sales performance improving all the time. But net income down. That's margin squeeze. That's costs up. And that is a negative scenario. When we see that, what we call negative jaws, that margin squeeze, it's a tough situation. They're forced to say, I'm going to put prices up, which might lead to weaker demand, lower sales, driving into inflationary expectations, but then also weaker growth. So that's stagflation. Or they have to wear it in the margin, which means lower profits. And that means lower multiples and share prices down. And at the moment, the ISM data is suggesting that inflation is not going to be benign. As you can see here, prices paid up strongly, employment down, as I mentioned before. That's a stagflationary outlook. And on this second chart, you can see that the ISM prices paid tends to lead inflation, the CPI number. With it up strongly, there's no reason at this point to think that the CPI is probably going to follow through. So it could be a tough decision for Powell next week. I think he's going to err on what he considers the side of caution and not cut rates if inflation's still there, and it's going to make for a messy time of things. Additionally, housing is weak, prices down, construction volumes coming down, building permits down 34%, supply of new homes at sort of record levels. We're in recessionary territory with this, as you can see on this chart here. And finally, tariffs have not gone away. ISM manufacturing, ISM services, you can see what the respondents are saying here. That is tariff concerns everywhere. Finally, on this front, I want to look at the broader market and see where the growth is and where it's stagnating. And at the moment, the Magnificent Seven are driving everything up strongly, as you can see, the pink bars here. The blue bars is the remaining stocks in the S&P 500. Showing quarter 2, 3, and 4 of 25 that the estimates are going to be weak, less than 3% each quarter. Now, if we move down the market cap chain, we're under more pressure. And more pressure if this employment data continues to weaken, CPI continues to strengthen, margin squeeze happens. And that's because of three things. And then I'm going to look at the IWM here, or the Russell 2000 index, because we've got 45% of companies or so at the moment that are loss-making. That is not a good situation to be in if we're moving into an economic slowdown. Secondly, these companies are impacted by tariffs, much more so than bigger companies. They struggle to push back on suppliers, they struggle to find alternate sources, and they struggle to pass on prices to customers. So those ones that are profitable are going to see margin squeeze coming through. And finally, they're going to face extra weakness in an economic slowdown. So if those unemployment numbers continue to get worse, the price index continues to strengthen, and we wind up in a recessionary environment, these guys are going to get hit hard. And so that's what I want to protect myself against. So this is a bit of an outlier trade. This is not my expectation. I don't have strong expectations for the market direction at the moment. I'm trying to be as agnostic and as neutral as possible. But if we're to see over these next few results for retail companies in the next month or so, through into the next round of results, and maybe rate cuts don't come, or they come and they come fast because the economy is slowing rapidly, I want protection. So the IWM trading at the moment, 221. This is an outlier trade, so I'm going further out of the money. I'm going to buy 190 puts. I can buy about 3,000 share equivalent, so 30 contracts. I'm going to short, so make basically a ratio bear put spread here, 1,500 of those, 170. And that gives me a little bit of leeway if things move down further from there. With that, my outlay is going to be about $5,500, which would be a sensible amount for a notional $100,000 portfolio if I'm looking to hedge this with some opportunities to move it around a little bit. And the payoff of 170, if we get there, would be 10 to 1. And that's what I want from an insurance type trade. This is not a 2 to 1, a 3 to 1 looking for a little move. This is protection against a big negative move to the downside. And it's there mostly to offset a whole bunch of long ideas that probably don't work out in that time frame the way that I would want. So that's like insurance. It's like house insurance. You don't really want to claim on it because it means your house is burnt down. But in this case, we have a big payoff, 10 to 1, and it's got to 170 as recently as April and got to 160 3 or 4 times since the rally post-COVID. So it's well within the realms of possibility. It's the sector that is likely, the segment of the market cap that's likely to get destroyed if we are too late on interest rates or if we have to cut them rapidly because we see that negative growth coming through in a recessionary environment. So there you have it, my insurance trade, protecting my portfolio in a worst case scenario of a recession as we sort of muddle through and try and work out what's going on with tariffs, what's going on with the Fed, and what's going on with growth. Thanks for listening. Talk to you again soon.